My name is Austin Fitch. I'm with Horizon Investments. I'm the Managing Director of our Consulting Solutions team. I'm joined here today by Scott Ladner, our CIO, and we're excited to get into the conversation around a quarterly review for the second quarter that we just wrapped up and really get into an outlook for the third quarter and the back half of the year. For those of you that are new to this call and maybe new to Horizon, we're excited to have you on. We're really excited to get into today's conversation and hopefully give you a sense of what we're talking about, what we're looking at, maybe what we're doing research on here at Horizon Investments. What you'll hopefully see on, I think it's the right-hand side of your screen, is the ability to ask questions. We would love to take your questions. We will try to get to as many of them as possible. If we don't get to your question, I will tell you that we will absolutely have somebody from our team reach out so that we can hopefully address those questions. And if we need to do a follow-up call, happy to do that with a member of our team. As I mentioned, there are a number of topics that we're going to cover today. You can see them, everything from AI, which has been a hot button topic, all the way down to kind of this equity market that we've seen to really start the year, where you've had a pretty crazy run in certain stocks and maybe a pretty boring first 6 months of the year in other stocks. So we'll talk a lot about some of the dynamics in play. One last thing I'll mention before we really get into the meat of today's conversation is, as part of the registration for today's survey, hopefully you saw a link for an advisor sentiment survey. We would love for you to fill that out. It's just 10 questions, and hopefully it allows us to get a sense for questions that you're getting from your end clients. It helps us tailor today the conversation today, but on a go-forward basis, it'll help us tailor our talking points. It'll help us tailor a number of our research topics on really what's relevant for you and your clients. So that's something that we would love for you to take, again, just 5 minutes, fill it out, hopefully fairly straightforward. And like I said, that'll allow us to then start to really, as we're building this content on a go-forward basis, make sure that we're hitting kind of those hot button topics. But with that, Scott Ladner, as I mentioned, our Chief Investment Officer, we've got him here today. We're going to start with artificial intelligence, Scott. And as we've talked about internally, there's a lot to unpack there. So let's start here. We've got a lot going on this slide. Maybe let's talk about that and maybe how we think about AI and maybe some of the comparisons that are being made and we're making when it comes to AI.
Yeah, thanks. And look, thanks for joining us. And I put this slide together because I did want to address some of the similarities that sort of, frankly, that we see here to what happened sort of the mid to late 90s, and really it also contrasted with what we saw the last 3 or 4 years with the whole kind of blockchain and crypto and Web3 sort of things that were going on in the market. And I'll say I did put a picture of Tom Selleck on here so that there's better people to look at than me and Austin. So you're welcome for that ahead of time. But the really important parts though are just reading across this table. The things that this AI revolution and that the sort of the internet revolution has had have in common, I think are pretty striking, and they're pretty important because they all kind of flow down to this last point, kind of last row, which is really sort of the main bullet I want to get to. One is that when you think about when as kind of PCs really took off in the 90s and as sort of the internet sort of took off in the mid to late 90s, it was really a pretty easy and obvious thing to use. I mean, you didn't have to have a ton of training to figure out how to use this stuff and how to implement it, how to kind of put it into business processes. Same thing I think is going to go for AI. I mean, the user interface for AI is kind of remarkably sort of elegant and efficient. The other big thing was it was really internet cut across everything. It was healthcare companies, industrial companies, even utility companies. Everybody could use, obviously tech companies, but everybody could use sort of the productivity gains that you got out of the internet and out of sort of the personal computing revolutions. And that's really going to be the case, we think, for AI as well. And so those two things really lead to this last row, and that is the ability to fundamentally impact the productivity of American companies and American workers. And the reason why that ends up being really important is because that ends up pushing the supply curve to the right in the economy. And supply curve moving to the right in the economy is probably the most important and sort of most fundamentally large scale thing you can get in terms of like improving everybody's way of life, improving living standards, improving and everything else having to do with the economy, it's just really hard to get. You get one of these maybe once a generation, if you're lucky. And so just to kind of refresh everybody's memory as to kind of what that, what sort of forces that unleashes in the economy. If you get supply curve moving to the right because of productivity gains, that is basically upward pressure on output or GDP growth and downward pressure on prices and interest rates. And so if you think about what the problems we have today, is slowing growth. We don't have slow growth, but we have slowing growth right now, and we still have inflation that is too high. And so really like this AI revolution, the productivity gains that we think we're likely to get over the next 3 to 8 years out of it are really pretty timely, and they really address fundamentally some of the issues that not only the U.S. economy but the global economy faces right now.
Scott, maybe a couple questions as we talk about AI. One that we oftentimes get is, okay, so if we're talking about AI and productivity gains, does that mean us as humans that we're all going to be replaced by robots and machines? So that's one. And then two, if you talk about AI in terms of investability or what are we looking at today, or are we looking at anything today when it comes to a market decision based on AI?
Yeah, look, I mean, I think it will change the way jobs are done, just like all technological advances change the way jobs are done, but it doesn't change the fact that jobs need to be done. We don't see this fundamentally as being very different in terms of like making workers more productive and therefore more valuable and therefore able to earn more money than any other sort of technological revolution we've seen over the last couple hundred years. So no, I mean, like short answer is it's not going to make people like interchangeable, like just like replaceable. You're still going to need people to figure things out, and you're still going to need wisdom about some of this stuff. And look, we don't know what we don't know about it right now. This is really, really first inning stuff. And so, we will continue to sort of evolve our thoughts on it as we walk through time. But on its face, no, we don't think this is like a job killing kind of technology, because technology is not generally job killing over the last 150 years. In terms of like, where do I invest? Like what do we actually do about it from the investment standpoint? That's a little bit tricky. There's only so many shares of NVIDIA to go around. And so, there is, today, the market cap of stuff that you can invest in that has a first order impact or first order sort of exposure to AI is small, and it's admittedly fairly small. But we think that's probably not the most optimal way to think about it. And we think probably the most optimal way to think about investing within AI theme is going to be certainly, yes, some of those NVIDIAs and some of the chip makers and some of those sort of like people that are right on the front lines of this technology. But it's also going to be, figuring out what are some of the second order effects. So like, what are the healthcare, which healthcare companies are embracing AI and which ones aren't? Which pharmaceutical companies are embracing AI, which ones aren't, or doing it well at least? Which industrial companies, which sort of consumer services companies? It's not going to be a like just NVIDIA, and NVIDIA is going to be and Google is going to rule the world, and you can't invest in anything else. This is going to be, for this to be productivity enhancing, like for this thesis to be correct, it's got to cut across industries. It's got to be sort of an economy wide phenomenon. And so we think like diving a little bit deeper into companies and firms that use this potential technology for its productivity enhancing merits. Those are going to be the ones we want to focus on. So it's really more of those second order effects, and we're still kind of doing some work on that ourselves.
Awesome. No, that's super helpful, and I think super interesting. I think maybe dovetailing into something that's a little bit more time specific and timely, even with the report from this morning, is okay. So we talked about how that may affect inflation longer term. But let's maybe take a step back and have that conversation about inflation and where it sits right now. This is a chart of the ISM survey data on business prices. That's the yellow line on this chart. Kind of that teal green line is CPI year over year. That actually, as of this morning, right, has another data point that continues to move that lower. And what you'll note is obviously a fairly high correlation, right? And we've been talking about this for a while, that the story in some cases has already been written. We're just reading it at this point. And what you see is that the data continues to point towards inflation going lower. But this is more kind of lagging data in terms of it tells us in a lot of cases what we have lived through, not necessarily what is coming. So Scott, we've done a lot of work internally to look for maybe more timely data, more real-time data, And I think there's a couple places that we think maybe give us a good picture of what the kind of the true, no pun intended, inflation is going to look like. Can you talk us through kind of what we're looking at now and what that means for a go-forward basis?
Yeah, so I mean, look, and you'll see this theme pop up a couple of times in this presentation. What economic data are useful and they're certainly helpful, but sometimes they can be a little bit slow. If you're talking about a weekly series or a quarterly series, like it only comes out not that frequently. And so if we're talking about something that is that's fast moving, we need to try to find ways to access data that is also fast moving. Use data with the frequency that you want to measure in order to forecast sort of philosophy. And so this firm called Trueflation has popped up over the last couple of years, and they've got this these data series out that are publicly available that you can say what is inflation doing on a more of a real time basis in the U.S. economy. And essentially what they're doing is they're going out and they're scraping prices off of a whole bunch of websites and other places and using that to construct a more real time sort of version of what CPI might look like or what inflation might look like in the United States. And so, if you just look at this chart, this chart only goes back a year or so. But it would suggest that we had a much worse inflation problem back a year ago than the official statistic would suggest. The official CPI was talking in the 9% range, and this Trueflation measure it's almost 12%. So it was saying it was much worse back then a year ago than what the government was telling us. But right now it's also saying that things are much better than what the official stats would suggest. And this kind of feels right to us, and we think that the numbers obviously this morning, the CPI numbers this morning would sort of bear this out as well. But this is just this is admittedly a fairly short data sample to look at. So luckily we can get a little bit longer data sample to look at with this Trueflation data and actually compare it against with the government information in terms of CPI. And you can see that it is over a decade long period. This stuff rhymes. The correlation is quite high to CPI, and certainly when you have things that are been much more volatile over the last couple of years in terms of the inflation numbers, that correlation breaks down a little bit, but it's directionally still very obviously correct. And so we do have some confidence in the fact, in sort of the continuing story that we've had for the last really 3 or 4 months here, that the inflation story, like Austin said, the inflation story has been written. We're just reading it right now, and so the idea that we're going to get inflation back under control here, probably by the end of the year, we have a reasonable degree of confidence in. But there is one fly in that ointment, Austin, and I think you're going to talk about that next.
Yep, absolutely, and we'll get to that. I think what is important though is also not just the inflation numbers per se, but it's okay. What does the Fed actually think, and what are they doing with that data? So we want to take a quick step back and look at the measure of PCE, which for those of you that aren't familiar, that's the inflation metric that the Fed actually uses to make their decisions. We actually broke it out on the right-hand side to look at goods in the top left-hand corner, look at housing in the top right-hand corner, and then look at services kind of on that bottom graph there on the right-hand side. And what you'll note is that really all three of those, if not starting to roll over, have already rolled over. And why we think that's important is because, again, as we talk about what does this mean for the Fed, what does that mean on a go-forward basis? It means that likely it gives them cover to maybe slow kind of the pace of rate hikes, potentially pause rate hikes. We'll get into the rate hike conversation here in just a second. But looking at it from the Fed's perspective, we think is extremely important. To Scott's point about the frequency of the data, we can look at different data sets and different data series to get a sense for, okay, what do we think is coming? But also looking at exactly what the Fed is seeing internally in their models and their systems actually gives us a pretty good idea. That the chart on the left is really a multivariate, so it's a core trend. Think of it as a factor model that incorporates 17 sectors from that PCE price index. So you're looking at kind of multiple data points and trying to, again, that blue line is going to give you that trend of the direction of travel. And we think that that's extremely important to understand, okay, what's the Fed seeing from their data, and is that going in the same direction? The good news is it absolutely is. And that's something that we think is important on a go-forward basis. Scott, to your point, the labor market is maybe the one piece that could be the fly in the ointment. what you have started to see, right, is that the labor market does appear to be normalizing. So this looks at this chart specifically is the quits rate. So it looks at the number of people, right, that are choosing to go find another job or leaving the workforce entirely. And when that's a little bit higher, that tells you that folks that are quitting maybe feel confident that they can go get a job somewhere else fairly easily. As that number comes down, what that tells you is, okay, maybe folks are a little bit more uncertain. They feel like they need to, stay put. They don't have as much flexibility. So you're seeing that normalization of the labor market. We think generally that's a good thing, but you can also see, this is 20 plus years of data, we're still, in absolute terms, still on the high end of kind of a normal labor market. You can make the case that we're still maybe above kind of average in terms of that quits rate. So that's something that I think we continue to watch. Scott, in terms of your team and looking at the labor market, what is it, in addition to kind of this quits rate, but are there other data sets, other data series that we're watching to continue to say, hey, is that job market, is that labor market, really the health of it going to be something that's going to allow the Fed to take their foot off the gas?
Yeah, I mean, look, it's everything from the JOLTS surveys. It's the certainly the continuing claims, the continuing jobless claims, and the initial weekly claims are a pretty frequent data series that you can look at. But there's really sort of just there's just kind of a panoply of things that you can and should be looking at if you're trying to assess something as complex as the U.S. labor market. And so we do try to break things down in terms of supply of labor and demand for labor. In some respects, and we're still seeing, if you can look at like NFIB, like business surveys, there's still quite a high demand for labor, and the supply of labor is still somewhat constrained from basically 55 plus age people not coming back into the labor force, and we think that's probably a permanent shortage, and so that's one reason why the AI stuff could really be particularly helpful to the wage front. But when we're looking at the labor markets, we are thinking in terms of supply and demand, and broadly speaking, what we're seeing right now is sort of rhymes with what Austin was talking about. The demand for labor is still pretty high, but not quite as high as it was, and the supply of labor is improving, but it's probably not going to be able to improve quick enough to sort of close this gap in a really timely fashion. So we're probably going to need to get more on the demand side for labor coming down, and we think we think the AI story can help with that.
Awesome. So Scott, we've talked a little bit about the Fed, but maybe let's shift gears a little bit and maybe more explicitly look at that yield curve and look at kind of what we expect in terms of kind of on a go-forward basis. We've heard a lot of talk about kind of the yield curve pricing in a recession. So let's unpack this chart because I think this is a good picture of maybe what we want to walk everybody through, and then we'll look at the actual data here in just a second and show them maybe where we actually are.
Yeah, I mean, look, it's a really, really common diatribe. Diatribe is not the right word, but I mean, people kind of go crazy on this idea of there's a yield curve inversion, therefore recession, like guaranteed recession. We're definitely getting one. Like why are you having this conversation? It's a stupid conversation to have. And like that's just missing. It's just really sort of missing the point. It has typically been the case historically that when you get a yield curve inversion like we've got right now, that has been a prelude to some sort of recession. But the yield curve shape has been different in those past periods, and so the reason why this is important is if the yield curve is kind of what's on the chart here. If the yield curve basically has two humps, that's a yield curve that's saying that the market is saying, yeah, we think a recession is likely. Here's why. If you think a recession is likely, you think the Fed has to cut rates below neutral, below wherever they think neutral is. Basically, you think the Fed has to go from being restrictive to being accommodative, because in a recession they want to be accommodative. They want to get us out of recession at some point. And so that's why you get this S-shaped curve. Is like we're too high right now. We're going to go in recession. That means the Fed's going to cut way too much, and it's going to go down. And then at some point when we sort of are coming out of it, the Fed can normalize rates, normalize policy, and we get back to whatever their conception of neutral is. And so that's the shape of yield curve that says the market is pricing recession. The shape of the yield curve where you only have one hump is just saying the Fed is too high right now, and we think that rates are going to come down towards their conception of neutral over some sort of indeterminate amount of time, think years, not quarters. And that's a yield curve that's saying we don't necessarily need to get rates into accommodative territory. We don't need to cut drastically to pull us out of a recession because the Fed caused one. That's the shape of the yield curve. That's more of a soft landing, more of a Goldilocks kind of scenario. And if we go to the next slide, guys, that's what we've got. That's what we've got. Like the yield curve right now is not saying we got these two humps. It's not saying the Fed is going to cut below 2.5%, 3%, wherever they think neutral is right now. It's in that neighborhood. It's saying we think that the Fed is going to cut rates because they don't need to have rates this high if inflation is no longer a problem. They want to have rates at neutral, like their long-term sort of conception of where interest rates should be that are neither stimulative nor sort of restrictive. That's the level that the Fed wants to ultimately get rates to. They know they're restricted right now. They know the rates are too high right now, but they're there for a reason. They're because they think they have an inflation problem. At some point, they want to get rates down to where they need to be, which is this neutral level, 3.5% in this chart. And that's the way that the market is pricing things right now. The way the bond market is pricing this, this is what it's telling you. It's telling you that we don't think necessarily that we have a place where the Fed is going to have to cut too much because we have a recession and then raise rates back up after the recession's over. We're just saying that we're going to cut gradually and get back towards neutral over some period of time. And so this is it's just not a yield curve that's pricing recession right now.
Yeah, Scott, I think this picture it paints a really good picture, if you will, of kind of what we're seeing. I also think it was an excuse that you want to put a picture of Lee Corso in the slideshow.
Any presentation without Lee Corso in it's a bad presentation.
So changing gears a little bit, we're going to maybe continue the conversation around this idea of maybe not going into a recession, but really bring a topic back up that we've talked about for some time now on a number of these quarterly webinars. And it's this idea that really the consumer and corporations, for that matter, are severely under-levered in a good way, right? The fact is that if you look at the consumer, that's the chart on the left, or the corporate world, that's the chart on the right, and look at kind of basically their level of leverage, what you'll notice we're near multi-decade, in some cases multi-generational lows. And that just paints a picture of a consumer and a corporate environment that is much healthier than you would really ever expect heading into kind of a recessionary environment. I think that the next chart actually really puts it pretty clearly, looking at just assets to liabilities for the U.S. consumer. You can see, yes, things have gotten maybe marginally worse over the last year or so. Remember, though, that asset base was built up coming off the back of some of the COVID stimulus money, right? So you've had that come back to a little bit more of a normal range in terms of longer term averages. But you can also see from an absolute basis, the consumer today is really healthier than they've been at any point almost over the last 30 plus years. That, again, as the title says, that's not what you would expect to see. The charts before on the slide before are not what you'd expect to see if you're heading into a recessionary environment. And the strength of the consumer, the strength of the corporation, we think maybe kind of tailwinds that allow for the Fed not to have to kind of continue pushing, or if they do continue to push, that is going to be able to offset that in some cases. So we think there's some opportunities, some really, if you look at kind of the strength of that underlying economy, we think that speaks a lot to maybe what could drive us in the second half of the year as we start to look at, okay, does that recessionary environment become a risk to the economy, a risk to the market? Again, the underlying data says, as Scott's slide just said, not so fast. Scott, the other piece that, and we briefly kind of touched on this a couple slides ago in the title, but if we're looking at the rate environment, the fact is that we did have low rates for a very long period of time, and companies have actually been able to benefit from that. So let's talk folks through this slide and then what that means, both from an economic growth standpoint, but also as part of that recessionary conversation, what that means there.
Yeah, I mean, look, these are all reasons why Fed rate hikes may not be as impactful to the economy as they typically are. I mean, so, when we're talking about underlevered companies and underlevered people, if you don't have to borrow money at 7%, why the heck would you? And what we're seeing is people may not have to buy, at some point, yes, at some point you're gonna have to borrow money. This doesn't go on forever and ever, amen. But we are in a place where, Austin was just talking about, the U.S. consumer is underlevered. Corporations are underlevered, and to the extent that they do have loans or bonds outstanding, I mean, look at this chart. The rates are locked in. They're locked in for a while. We don't have any kind of looming maturity wall in corporate debt markets. We don't have any looming maturity wall in loan markets. There is nothing coming in the next couple of years that says firms have to refinance. They're going to refinance from a 2%, a 3% bond rate or loan rate to a 10% loan rate. If everybody had to refinance, yeah, we'd be in trouble. We'd be really pretty worried about things. But this is showing that we've got 2 to 5 years for the most part in terms of Russell 3000 companies before refinancing needs really become apparent. And we think rates are going to be back in that 3% range by the time we get there, with really no problem at all. So if we're worried about Fed rate hikes sort of killing the economy, it is definitely having a dampening effect. I'm not saying there's no effect out of this stuff, guys. I'm just saying that I'm making a suggestion to you that maybe are really good reasons why it's not having as much of an impact this time as it has in the past, and it has a lot to do with how we came into this recession being very, very underlevered, and company treasurers doing a pretty darn good job locking in low rates while they could over the last 3 or 4 years.
So Scott, another piece that, and maybe we'll tackle a couple kind of headlines that we've seen over the last, call it 6 months at this point, that would maybe put some fear in folks. The first being credit card balances for consumers. I think this is a chart, and we'll talk about this, but let's unpack what are we really seeing as opposed to maybe what the headlines want you to see.
Yeah, so look, the only reason I put this chart in here was because I was getting a lot of questions about these headlines, kind of fear-mongering headlines that were credit card balances on a year-over-year basis are exploding. People are just they're going crazy on the credit cards, and that's unsustainable because credit card rates are 1,000,000%, and so why this is a disaster waiting to happen. No, it's not. Nobody used credit cards for the last 2 years because everybody had checks. So what we're looking at here is per capita credit card usage or per capita balances of credit cards in the United States going back for a pretty long time. And you can see that big dip. That big dip is when the government paid everybody money to not do anything. And so if you have cash and you're sitting in your checking account, why in the world are you going to go out and use a credit card to buy things? You don't, and they didn't. And so ergo, this big dip. So if the analysis you're looking at is a year-over-year comparison, if you look at it last July of 2022 versus July of 2023, that number is gigantic. It's a huge increase. So what? You can't, we're just back on trend. Credit card per capita credit card usage basically back on trend to where it was. And so that's this to us is kind of a rather large nothing burger. But and in the green in the green box inset was some conversation I was having with somebody on the JP Morgan derivatives desk. I bet and they've got a lot of consumer information, and you can just see here delinquency charge-off rates, delinquency rates are in 150 basis point range right now versus all these other historical periods that are listed in the page. Two something in December 2019 before COVID hit. All these other numbers. It's just that not only are credit card balances not really an issue, but charge-offs and write-offs are not really an issue either. People are paying their bills. They're paying their bills because they're employed and they're getting raises. So it's this is just not. I just want to sort of dispel the idea that this people are going crazy on the credit cards. This impending disaster is just factually incorrect.
And if we talk about kind of dispelling certain things, we've had a lot of questions, Scott, about money supply, right? And the fact that you started to see that kind of come down. I think, and correct me if I'm wrong, and feel free to add on, I think it's the same story in terms of it's really just a normalization back to long-term trends. Yep,
that's pretty much it. And look, to be clear, we are not proponents of money supply being a really important factor in anything. Money supply has not been an important factor in anything since Bretton Woods. So we're talking 50 years, where money supply really has not made very much of a dent, very much of a difference in anything. And it shouldn't because velocity is now very, very volatile. And so if the Milton-Friedman equation of MP equals or or whatever, the sort of the monetarist equation where they hold the velocity of money constant, then it's if the velocity of money is not constant, then the supply of money is just not as impactful for prices and for output on a go-forward basis. And so we don't really subscribe to the idea that money supply is a terribly important thing in the economy because empirically it's not. Any data study, like any study you look at for the last 25, 30 years, just doesn't really matter that much. But if you were wanted to subscribe to such a theory, then this is not really mattering either. Like it's basically just kind of back down towards this kind of very long-term trend that we've had. Still a little bit of work to do on this front, and we think it's probably a marginal headwind to things, but we don't think it's anything terribly impactful again.
So one thing we have seen and we're monitoring internally is some consumer spending data. And this is some real-time data that a firm puts out. And what we've done is we've actually created different baskets. So we're looking at entertainment, we're looking at goods, we're looking at services, and you can see the various baskets highlighted here. What you'll note is it's actually a pretty boring chart. And what I mean by that is there's not any massive drop-offs. There's maybe marginal trends here and there. You can see that spending on goods over the last year or so has maybe been marginally negative. Well, yes, remember that we all bought way more goods than we could probably ever need over the course of 12 to 18 months, starting in March of 2020. We were stockpiling, refrigerators and couches and definitely toilet paper during that period of time. You've seen that pull back, but again, you haven't seen anything necessarily fall off the cliff. And Scott, I think that's what we're trying to communicate with this chart is there's really not a whole lot to see here. We're obviously watching to see if that changes dramatically and something, really does start to dip even lower. But right now, it's pretty uneventful. Is that fair?
Boring is good. When it comes to consumer spending, boring is good. We'll take it.
Yep. So the one piece that maybe we have heard some concern about is that commercial real estate space. As we all know, commercial real estate, just the market landscape, whatever you want to call it, has changed pretty dramatically over the last 3 years. The need for office space in certain areas of the economy has changed dramatically. So there's a lot of folks that are asking, okay, if commercial real estate blows up, is that going to be the catalyst that triggers a recessionary environment? And Scott, I think there's a few things that we're looking at that would suggest that we really don't see a blow up per se. And if we do, maybe it doesn't have the same impact that a lot of folks are at least have pictured in their heads.
Yeah, look, this is another probably nothing burger with respect to the sort of big economy. But commercial real estate. What we're looking at here in this chart, guys, just to set everybody's mind up, is the blue line on top is this is commercial mortgage-backed security spreads or prices. And so the blue line on top is AAA, is basically top of the cap stack, and the gold line is the BBB stuff, is like the stuff that's most at risk if loans stop getting paid. And what my point of this was showing this chart is there's already a lot of losses in the price. So this has already been priced in quite a bit. That you can see that that BBB stack going from $90 down to $70. Like we've already got $30 worth of impairment basically built into prices of commercial mortgage-backed securities. So you can say there's a lot more to go, and maybe there is. I would probably push back and say there's a section of commercial real estate that's a problem, like the central business district office tower space. Probably not the place you want to be investing in, or if you were you probably take some losses. And so there will be people that lose money on this. There will be firms that lose money on this, and there will be banks that lose money on some of these loans. But everything we're seeing out of multifamily, everything we're seeing out of strip malls, everything we're seeing out of all the other parts of commercial real estate are basically saying this is not much of a problem. And even if it were, it can be a huge problem. This is, again, if anybody's I'm sure a lot of y'all have invested in commercial real estate in the past. That this isn't like buying a house, especially like a liar loan house from 2007, where you put 0% down and you lied about your income. There's no equity cushion in that case. The loan to value is 100%. Loan to value for a commercial real estate deal is 50, 60%. If you're buying a $10 million property, you better come with $4 million in cash. And the bank will give you the other 6. So, the bank's already got a lot of kind of equity cushion protection built in the side of the structure of that. So it's not like these things have to collapse, they go down 5% and all of a sudden we're getting capital calls and we're having sort of forced liquidations of commercial properties. We're just not there. So this is a different beast than the sort of the real estate centric crisis that we had in 2008. And so again, this is one that's kind of sort of the top of the mind worries for a lot of folks. And I'm not saying that people aren't there. There are not going to be some people that lose money on some of the stuff. There will be. But what I am saying is that there's a lot in the price already. And that this is not a systematically sort of important thing in terms of the internet connectivity of commercial real estate. with the large bank like money center banks in this country.
Yeah, I think that's a good point, Scott. There at the end is the lenders in a lot of cases for the commercial real estate space are different than the lenders for the mortgage backed, like the residential mortgage space, which obviously was a big difference or a big issue in the 2008 kind of great financial crisis. So Scott, a couple last slides that we'll touch on. Again, if we're looking for some similarities of historical markets that maybe are potentially entering a recession or maybe the soft landing environment, I think there's one that we want to highlight that we think is pretty interesting and maybe has some similarities to today that probably goes further back than a lot of folks were even alive at this point. So let's talk through that and give folks an idea of kind of what we're looking at.
Yeah, I would venture to say that what I'm going to talk about is like probably 98% of the people on this call were not alive for this, and we're certainly not in markets when this went on. And so it's been people have been torturing themselves over the last couple of years to find similarities to the 1970s for what's been going on in the economy and what's going on in the markets. And so every analysis to look at historically is like harkens back to sometime in the 70s. And we think that's a really bad example, really poor example. Even if you subscribe to the fact that, or the idea that historical analysis can be really enlightening, and occasionally it can, like history does repeat itself sometimes, or rhyme at least. But we think a much better analogy or sort of like thing to look at in terms of like what was going on in the economy and what ended up going on in markets subsequently is the post-World War II period. And the reason for that is there are three large similarities, like pretty important similarities to what we just went through with the COVID thing and what was going on in the later stage of World War II and sort of the recovery right after that. One is, during World War II and in COVID, we had really bad supply chain interruptions. Like one, because like the global economy shut down because there was this killer virus out there. But the other one was because there was a global world war. So that would cause supply chain issues, and it did. So that was a problem on the supply side of the economy. On the fiscal side of the economy, like obviously we had massive wartime spending in World War II. So like the fiscal thrust in this country was absolutely gargantuan. Same thing we had in COVID. Like government spent a lot of money to pay people to hang out, right? And so that's a pretty important similarity, we think. And by the way, that caused a lot of inflation in post like right after World War II, and it's caused a lot of inflation this time as well. But the other sort of main similarity we had is like we had a kind of an odd labor market shortage. Obviously in World War II, like people were out fighting with the war, and so you had labor market shortage. That as they came back, that certainly got better. But that latter stage of the war, like there are a lot of folks that weren't available workers that weren't available to work. They were overseas. That same sort of thing here in the COVID period. Like we've had labor market shortages because people were either sick or or not willing to come back into work, or for whatever reason, or got rich enough where they don't have to work again. And so like we the same sort of dynamics we had economically in sort of the latter part of World War II and right after. We think that's probably a pretty reasonable comparison of what we're going through right now. And it's instructive, at least to understand like what happened after World War II and after some of these things sort of naturally became better. We had inflation, inflation ended up collapsing like after World War II. We had equity markets, even though they went through a technical recession, like equity markets didn't really budge. Like they kind of continued higher, like risk markets ended up being okay. And so we think that, that if you subscribe to like, I want to see the historical analogy to understand things idea, we think that post-World, the late World War II and post-World War II period is a far better place to start your analysis than anything having to do with the 1970s.
Awesome. No, I think that's super helpful and good context historically, Scott. The last slide that we have today really hopefully kind of lands the plane to some extent as we talk about inflation. We've talked about interest rates. We've talked about kind of what's the effect of all of that. Are we going to enter a recession? I think what's interesting is the reminder, right, that earnings are nominal, and that has a pretty big impact. So let's look at this chart, maybe give folks an idea of exactly what we're looking at, but then also what it means on a go-forward basis.
Yeah, I mean, like so, the two things on this chart. The blue line is nominal GDP, so not real GDP. Is like output plus inflation, basically, and the red line is S&P 500 forward earnings per share. And so what we see is like earnings per share has already been like the forward earnings are already like flatlined. So like we've already had sort of the earnings, not recession, but we've at least had a flatlining of earnings these these last several months on a forward-looking basis, forward earnings. And what I would suggest to you is that earnings are more of a nominal variable than they are a real variable. And so to the extent that we get nominal growth like slowing from the sort of ridiculous pace that it was at last couple of years in terms of like the like 10, 12, 14% of nominal growth, a large part of which was inflation, just to be clear. Earnings are supported by that. Like that is helpful to pricing power. That is helpful to revenues, and obviously and therefore helpful to earnings per share because margins weren't getting compressed. And so on a go forward basis, if we do have a growth slowdown and we get nominal growth down in the 5% range, 6% range, something like that, that's still supportive of earnings. That's still supportive of actual growth from here. Like when earnings right now are priced at 0%, like basically flat for the next 12 months. If we get nominal GDP growth at 5 or 6%, and we have inflation clearly coming down, and we have a Fed that says we're done or we're really close to being done, hurt me. I mean, that's a good outlook, guys. Like not only you're gonna get multiple expansion because people are gonna be more clear about where rates are, but you're gonna have earnings being able to support that, being able to support it as well, because they're going to trend back towards where nominal GDP growth are going to be. And so like we actually think this is a pretty reasonable backdrop for the rest of this year. It may not be kind of like the mega cap tech led everything up rally. I think maybe a little more subtle, a little bit more rotational the second half of the year in terms of like maybe some of the cyclical stuff catching up, maybe some other things catching up that didn't perform as quite as well for the first half of the year. But we think overall, like the backdrop for equity market investors for the remainder of this year is certainly better. It's definitely tilted towards the good side.
Awesome. No, Scott, super helpful and appreciate you kind of walking us through that. I think the last kind of bullet point here on this takeaway slide actually hits it really exactly what you were just talking about. It's really what happens when or as the headwinds that we've been facing for the last, call it 3 years at this point, start to fade. And again, it's not if they fade, it's when they fade, it's as they fade, because as we've talked about, the pessimism will likely start to turn. Global growth will start to come back. And when that happens, it's a question of the strength of the consumer. Is that what allows us to really take off from here? Scott, you hit on one other thing, and a question that did come across is just maybe we can talk about kind of our view on it, and you touched on it just a second ago, I think, as to where you'll take this. But this idea of the Magnificent Seven, right? The 7 companies inside the S&P 500 that have been driving really, it seems like everything the first half of this year, right? The Amazons, the Googles, the Metas of the world. If we're looking at those 7 stocks and what they've done year to date, maybe versus what the other 493 of the S&P 500, but then all of the mid and small cap companies, what's our view on those growth oriented names, what they've done so far, what they're going to do the remainder of the year, and then again, as you kind of I guess got into, what does that mean for the rest of the market?
Yeah, I mean, look, we think that there probably is room for some catch up to be played with the rest of the market to those so quote unquote Magnificent Seven. I love names that people come up with. That's a good one. So look, and this is a correction that it doesn't have to be like those 7 stocks like crater, like they come down. This does not have to be like an internet bubble bursting, because in the internet bubble bursted, like a lot of those companies weren't making any money, or they're making very, very little money. They had like 70 PEs and things like this. Like this is not the case this year, like this go around. This can be a correction through time. So like via time, like rather than like correction by like stocks cratering. So if we think about NASDAQ kind of or sort of these Magnificent Seven, just not outperforming by as much as they have for the first 6 months this year, and some of these other sectors and some of these other stocks playing a little bit of catch up, we think that's probably a little bit more likely than this the trend continuing for the rest of this year. But you can't completely dismiss that idea as well, because just because of how powerful some of these earning streams are with the Googles and the Metas and the Facebooks the Amazons and things like that. The ones that have scale in the AI game are generally going to be the ones that win. And so this is it's a little bit of different one to try to figure out, but we do think like if that correction is going to happen with the Magnificent Seven versus the rest of the market, is probably going to be via time happening. Just those stocks kind of just treading water and everything else playing a little bit of catch up, rather than like this kind of convergence where one goes down, one goes up.
Awesome. Maybe last question, Scott, and this is timely based off that CPI report this morning. Is there anything that changes with the Fed's kind of July decision that we have kind of upcoming with today's report. Is that going to change their tune of hike versus no hike? Does that change the path that we see for the remainder of the year? Is there really any impact specifically from today's report, or is that something that the Fed's maybe already kind of baked in?
They might have baked it in. And look, to be clear, like, to be honest, like, we have some disagreement inside of our team about what the Fed's going to do in July and in September. So it's not like we're not sort of like monolithically all agreeing on this either right now. I think it's in the neighborhood of a coin flip, probably tilted more towards the Fed's going to hike in July side than not. But I don't think it's a certainty by any stretch. And part of the reason is because of some of the numbers we're getting today. And some of the labor softening numbers would that we expect to get a little bit softer. So, like, we'll see. Like, I don't know. Like, I don't really know if it matters that much, Austin, whether we're in the bottom of the ninth inning or the game's actually over. Like, we'll know pretty soon. But it's, like, if they do hike in July, like, it is our thought that that's probably the last one, because we are getting inflation readings that are increasingly good. And by the way, let's not forget, the Fed knows they're restrictive right now. Like, the Fed knows they have rates really high relative, like, they think they're being very restrictive right now. And so, if you think you're being very restrictive and things aren't happening as your models would expect, then it's like, again, you can figure this out through time. You can just hang out for a little while. You can keep rates very, very high for a little while. You don't have to get like ever higher and make the job of normalizing that much harder on the go forward basis after you're done. So, like, it would make sense to a lot of sense to us to have, if they hike in July, like, maybe that's it, and we just hang out there for a little while and let the data continue to come in. But we're just not getting data in this country, and especially, like, if you understand what's the disinflation and deflation that China's starting to export around the world, we're just not getting some of this stuff. Like, the data in the U.S. that means that the Fed has to go like 6, 7, 8% in Fed funds. Like, it's just not there. And so folks that are calling for that, we would vehemently disagree with. But we do think that the Fed will try to solve this by the passage of time, more so than with continued rate hikes.
Awesome. Scott, really appreciate your time this afternoon, and appreciate all the questions that did come across. As I said at the beginning, we would love to continue the conversation. So if you have more questions, if you want to know, how does any of this affect, a specific model or portfolio, please don't hesitate to reach out to our team. We've got a number of different ways to get in touch with those folks, whether that's the internal desk, whether that's a regional director, whether that's a member of our consulting team. Really, any of those ways, we would love to have further conversations. And like I said, just continue to share with you what we're seeing, and then obviously how that affects decisions that we're making on the investment front. So with that, we'll put a wrap on today's call. Again, thank you so much for taking the time to join us, and really look forward to being in front of many of you in the coming quarter, and hopefully back together again for this same call as we get started in October. So thanks so much, and hope everybody has an awesome day.